Hey everyone, and welcome to this explainer. Today we're diving deep into Pravang Gandhi's Capital Compass issue number 2. We need to unpack a sudden, aggressive market pivot that literally just flipped the global currency map totally upside down. You know, if you've been tracking Forex markets for any amount of time, you know regimes can shift in the absolute blink of an eye. So today, we're going to roll up our sleeves, look closely at the data together, and figure out exactly what just happened to the US dollar over the last few days. And, more importantly, what it means for how you position yourself moving forward.
Here is our game plan. We'll start with how the dollar narrative paused, track the actual regime shift, deep dive into key currency pairs, look at the biggest danger zone out there right now, and finally, prep for 3 upcoming market catalysts.
All right, Section 1, the dollar narrative pauses, the NFP shock.
Okay, let's set the scene. Just last week, the anchor narrative, the thing everyone in the market was betting on, was the structural decline of the US dollar, all based on anticipated Fed rate cuts. Heading into Friday's non-farm payrolls, or NFP release, the market was super comfortable. Everyone was expecting a cooling labor market. The consensus forecast? Only 85,000 jobs added for May. Traders were heavily positioned for exactly this outcome, totally expecting a weaker dollar.
But then, bam, the actual number drops, 172,000 jobs added. I mean, that is literally more than double the forecast. Instantly, this absolutely killed the near-term rate cut narrative. The logic here is pretty straightforward, right? A labor market adding 172,000 jobs while sitting at an unemployment rate of 4.3%, it completely removes any urgent necessity for the Fed to step in and cut rates. In response to this, the 30-year Treasury yield surged above 5%, and the dollar just spiked dramatically across the board. This double shock of higher jobs and soaring yields forced a total reevaluation. Pravang Gandhi puts it perfectly in the report. He notes that when the market regime suddenly changes, your framework has to adapt instantly. Quote, "The regime changed. The tool must change with it." It's just a fantastic reminder of why looking at objective data is absolutely vital when our core assumptions get challenged.
Moving on to Section 2, Tracking the Regime Shift. Quantitative realities. So we have to ask, how did this massive employment shock rewire the Capital Compass regime's scorecard? Well, the absolutely critical question for us this week is figuring out the difference between the long-term structural downtrend of the dollar and this violent short-term counter-trend bounce. By using the R-squared metric to measure exact trend strength, we can figure out if this is a total permanent reversal or just a really heavy bounce. And the DXY, the US dollar index, shows a fascinating shift. The R-squared trend strength barely changed at all. It just inched up slightly from 0.55 to 0.58. But here is the kicker. The direction flipped entirely. It went from a clear downtrend straight into an uptrend. This is why reading just the trend strength alone isn't enough. The regime scorecard caught this directional flip perfectly. The dollar is rebounding, it's showing moderate trend strength, but it's heading in the completely opposite direction compared to just a week ago. Now, the most dramatic manifestation of this whole shift? That's USD CHF. In the previous issue, the Swiss franc was showing confirmed solid strength against a weak dollar, sitting at an R-squared of 0.58 in a downtrend. But this week, the trend strength stayed incredibly stable at 0.52, but the direction violently flipped to an uptrend. The dollar recovered even against the safe haven Swiss franc, so it has the same numerical strength but a completely opposite trajectory. This is the dollar recovery making its presence undeniably known. All right, let's jump to Section 3, Deep Dives, Key Pairs. You know, it's one thing to just say the dollar is strong, but it's another to see exactly where the technical battle lines are being drawn. Let's talk UR/USD. The pair naturally pulled back from its high of 1.1638 down to 1.1563, obviously due to that dollar strength. The R-squared trend strength dipped a little bit, but, and this is a big but, as long as the price holds above the 21-day exponential moving average support line at 1.1490 on a daily close, this is considered a totally healthy pullback. That 1.1490 level is absolutely the line in the sand right now. Meanwhile, looking over at emerging markets, USD INR saw a staggering 2% weekly move. It soared from 91.89 to 93.87. Look, for a managed currency, a 2% move in a single week is practically seismic. It's pushing dangerously near its 52-week high of 94.19. What this is telling us is that the strong dollar pressure is completely dominant, and it likely means the Reserve Bank of India is going to have to step in and actively defend that 94 to 94.5 range to stop things from getting destabilized.
Which brings us nicely to Section 4, the Intervention Danger Zone.
Okay, so while the RBI might be stepping up to defend the rupee, there is another central bank authority that traders are watching right now with bated breath. With the dollar surging across the board like this, we have to ask a really important question. Where is the absolute most dangerous long position in the FX universe right now? Like, where is the risk of a catastrophic reversal the highest?
The answer, undeniably, is USD/JPY. Driven by this sudden dollar recovery, the pair is pressing upward to 159.31 and entering the highly perilous 160 zone. Now, why is this so incredibly dangerous? Because this is the exact territory where the Japanese Ministry of Finance is primed for immediate, sharp intervention. With RSI and stochastic indicators approaching seriously overbought levels right inside this intervention zone, holding a long position here basically means you're stepping directly in front of a central bank freight train. No thanks.
So the crucial point is knowing what to actually do with all this information, and it's neatly distilled in this actionable cheat sheet from the report. For DXY and USD/CHF, the signal is to buy the dips, ride this short-term upward momentum. For Euro USD, the play is to sell the rallies until we see if that 21 EMA holds up. And for USD JPY, the signal is a resounding wait. Seriously, do not get caught in the MOEF intervention crossfire. Having a clear, unbiased summary like this is exactly how you survive a regime shift.
All right, final part, Section 5, 3 upcoming market catalysts.
The market is super dynamic right now, and the regime could shift again rapidly. Looking ahead, there are 3 major events you need to have circled in red on your calendar. These could either validate this dollar bounce or just kill it entirely. First up, Kevin Warsh chairing his first FOMC meeting. Second, a final determination on the Iran ceasefire MOU. And third, critical inflation and foreign investment flow data coming out of India. Let's break down the impact of those top 2.
So the Warsh FOMC meeting on June 16th and 17th is pretty much the ultimate binary event for the second half of 2026. Right now, markets are pricing a 93% probability that they hold rates steady. But honestly, the tone of the meeting is what really matters. A hawkish surprise from Warsh that accelerates this recent dollar bounce, meaning you'd want to fade those Euro USD longs. Conversely, if he takes a dovish stance, it resumes the structural dollar weakness thesis, which would mean re-entering Euro USD longs on a break above previous highs. It is quite literally a fork in the road for the dollar.
Impartially observing the geopolitical landscape, the upcoming Iran MOU decision from the Trump administration is also going to heavily dictate global risk appetite. If the deal gets confirmed, a risk-on sentiment resumes, and the dollar index likely softens again as safe haven demand just evaporates. However, if the deal is rejected, an uncertainty premium immediately gets priced into the market. That will bid up both the dollar and the Japanese yen. It's a pure geopolitical risk play, and it will be reflected instantly in the charts. I want to highlight something Pravan Gandhi profoundly concludes within the report. The trader who prepares on the weekend owns the week. And that's exactly what this explainer is. It's your preparation. By understanding the real data behind the NFP shock, respecting that R-squared regime flip, and knowing the exact technical levels for the week ahead, you aren't reacting to the market out of panic or fear. You are anticipating it with structure and logic. So I want to leave you with this to ponder as we head into what is guaranteed to be a highly volatile week. Are you positioned for the overarching structural downtrend, or will next week's events prove this violent countertrend bounce is our new undeniable reality? Keep a really close eye on those key EMA levels, respect the intervention zones, and let the data guide your compass. Thanks for learning with me today, and I'll catch you on the next explainer.